In 2025, Clark and I decided that we're going to start bringing you more actionable tips so you can listen to the challenges that we face on a daily basis. If there's something that we observe, there's a conversation that we're having and we feel it's an important thing to share with you, the listener, well, we're going to hop right in and we're going to record it right there and then when it's fresh in our minds and it's relevant to you so that you can be a smarter, leaner investor and that you can burn your boats too. Today, I've got an episode for you. It is, what is riskier? Doing nothing or investing with a strategy or hiding behind the concept of being a conservative investor, where in fact, you might actually be simply an uninformed investor. Let's dig right into this topic. It's a good one. Hello, and welcome to another brief, short episode with me, your host, David Shaw. We're here to have a little chat about our burn your boats concepts. So today I would like to talk about conservative investing versus high risk investing. When I was a kid, I grew up in an extremely conservative environment in Ireland in the 1970s and 1980s. And nobody around me knew anything or said anything or spoke to me, or I never even heard a word about, investing in equities or bonds or ETFs or anything of that nature. And if there was any investment vehicle that anybody supported at all in any way, shape or form, it might have been real estate at most. Okay. Then in the 1990s, thereabouts, the Irish government privatized our telecoms company, a company called Eircom. And every single household in the nation bought Eircom shares. Everybody I knew. It was a frenzy. It was hilarious. But that got me to thinking about where Ireland, as I look back at this time in history, was Ireland particularly conservative or was Ireland illiterate financially? And that's kind of a little bit more hard hitting when you think about it, that growing up in a financially illiterate environment is a little bit more to digest than a financially conservative environment. But that environment deeply impacted me. And so as I started out in my life, in my career, I did everything that I was supposed to do. I went to college, I got my degrees, I went to work, I did all of I got my salary, I saved. I was a fairly conservative person when it came to spending, never, was overtly spent money on myself or wasted money or anything like that. And so I went through my 20s and indeed into my 30s with that approach, with that safety, security. And I would have thought I would have used the word financially conservative, but I actually more prepared to use the word financially illiterate. That's, I was probably fairly financially illiterate up until and including my early 30s. The only investment vehicle that I would allow myself dabble in even earlier in my life was real estate, because real estate seemed less risky to me. And I understood that I had a lot of time to let it play out. And so, like everybody else, who's in real estate, I did one deal, I did another deal, and so on and so forth. But as I sit here today, a couple of thousand conversations later, it really dawned on me that it's ironic how many people will only take action when the risk of not doing something becomes riskier than the associated risk with the thing that they are planning on doing. And that's amazing to me. Just think about that for a minute. People only act when non-action becomes riskier than action. It's really hard hitting, And ironically, a lot of older folks start to take on way more risk later in their lives because they were so conservative earlier in their lives. Now, were they conservative or financially illiterate? I'm not sure which it is. I'm going to quickly talk about this is when people hide behind, oh, I'm very conservative. Are they actually pretty financially illiterate? Are they genuinely conservative? So it is clear to me after having many, many thousands of conversations with people, there are people who play the conservative card up until their late 40s, sometimes into their 50s, and then they have this oh shit moment and they start having to jump on things like, rocket ship stocks. They start individually stock picking. They start, buying bitcoins. Yeah, some of them will work out, some of them will not. They start buying super high cash flow real estate in dodgy neighborhoods. Or worse again, in my view, they start, believing in some of the marketing that's out there about, certain syndications that are promising super high preferred returns and super high IRRs with a really, really short window of, this is a 3-year 22% or 25% IRR with a, 15% preferred return. I'm being a little bit facetious on that, but I see it all the time. And the truth of the matter is, even, at later in your life, if you are thinking about investing in those kind of things, there's no amount of due diligence that you can do to protect yourself. These are complicated, complex things, these big value add projects. There's so many things that can go right, and there's so many things that can go wrong with those macro, micro, operationally, and anything in between. Globally, quite frankly, the US government could borrow too much money, interest rates could go up, and that's going to take your investment out of it. That 22% IRR might become 100% catastrophic loss when the value of the asset that you've invested in becomes lower than the debt that's on that asset. And so, first people to get wiped out are the operators. The second people to get wiped out are you, the investors. I see this all the time. And it's really sad when I see people who have played it safe. They've done the right thing all their lives. They've been conservative in their mind. And now they have money, but they have this oh shit moment. They're like, man, I need to do something now. They could be 48, 49, 50, 60. So they could be in their mid 60s. And they start hopping on these, these what I would call pretty exotic products. I would much prefer if you could pass this message on to anybody younger, anybody who's in their 20s and 30s. The very, very best way to invest with the minimal amount of risk is having the time in front of you. That's number one. And to invest in just things that have been around and things that have worked for decades, if not centuries. Things like high quality real estate in a high growth environment, in a good neighborhood, hold that for 20 years. It's not sexy, it's not exciting, and guess what? It's not going to get you rich tomorrow. Just not. It's not the way it works. Also, take your money and invest in broad-based ETFs in something like the S&P 500. The global economy and the US economy will, over the next 20 years, continue to grow. There will continue to be innovation. There will continue to be inflation. There will continue to be the top 500 companies in the world. Even in a global downturn, the top 500 companies in the world will remain the top 500 companies in the world. And the ones that don't will fall out of the S&P, and all of the newcomers, all of the new technologies, all of the new high growth stocks will make their way in. So by investing in the S&P, you are always investing in the highest performing companies in the global economy. If you couple dollar cost averaging into the S&P 500 every year for the remainder of your life, from starting out as early as you possibly can, and hopefully your parents can start you out. If you really, really have those parents that can, put $100 a month every single month into a little stock account for you when you are born, you will never have financial problems. If you own real estate as early as you possibly can, Even when you're in college, even when you are starting out your very first job, figure out a way to buy a duplex and move your buddies in next door and move a roommate into your two bed. And so have all of these people pay off your mortgage for you every single month, even when you're 23, 24. This is what makes success guaranteed, and it's not risky to do these things. You're not taking on risk. If you dollar cost average into real estate your whole life, dollar cost average into things like stocks, bonds, talk to your financial advisor as early as you can in your life. Set up a Schwab account. Just take it directly from your wages, $100 a month, every month of your life, and buy VOO or just some broad-based MP stock, but do it your whole life. Make it habitual, because wealth building is habitual. It's a habit. You just get used to it. I want you, the listener, to avoid getting into your 50s and 60s and having an oh shit moment where you start looking out at these, really, really, nasty syndications that I see out there. And, some funds that some of them are great. Some of the syndications are great. I'm not saying all funds are bad, and I'm saying all syndications are bad. I'm not saying that at all. I'm just saying they are more risky than the strategy I just outlined. And, putting your money into, any of these shit coins or any of the, rocket ship stocks. An individual stock can really, really make you wealthy, but the chance of you finding more than one of those in your life are pretty slim. So I implore you, understand what risk is, right? And don't wait under the banner of I'm conservative, making yourself feel better. You're probably more likely to be financially illiterate than you are financially conservative. So teach yourself about how things work financially so that you're not having to find yourself in your 50s and 60s and 70s investing in exotic products that probably won't work out. And I say that because I come from that background, and I tell you this because I've made these mistakes. This isn't, I'm not preaching from on high here. If I had one wish financially, it would be that I knew what I've just said over the last 10 minutes when I was 22. So with that being said, I think the message has been passed across. Pass this message on to anybody younger. Make sure that they don't think, investing dollar cost averaging into something like the S&P or investing and getting roommates in a duplex is risky. It's if you have a long horizon, it literally is devoid of risk. There's certain things that can happen. That's true if you go out and you drive to work today. There's certain things that can happen. I'm not saying the risk is zero, but the risk, I just see it so much later on in life. I see people taking on extremely, extremely high risk investments where if they've just followed these few tips earlier in their lives, they could just whistle on by as they see the SIF coming into their inbox. So with that, have a great day. Pass this on. We always love your feedback. Thanks for listening. Thank you so much for tuning into today's episode. Look, we truly appreciate your support and hope you found the conversation insightful and engaging and useful. If you enjoy the show, because there's a lot of shows out there, would you please take a moment to rate and review us on your favorite podcast platform? Your feedback helps us grow and reach more listeners. And if we reach more listeners, we will have bigger and more interesting guests. Please go ahead and subscribe so you don't miss the next episode. We hope you enjoyed today's show. Thank you so much.
You've been listening to the Burn Your Boats Wealth podcast with Clark Lunt and David Shaw. We would love to hear from you. Please reach out at contact@burnyourboatswealth.com with comments, questions, and if you have a topic you would like Clark and David to discuss on an upcoming episode. We would very much appreciate it if you took the time to rate and review Burn Your Boats on your favorite podcast listening app, and make sure to follow and share on social media. Content in Burn Your Boats Wealth podcast is for entertainment purposes only and is not legal or financial advice. please review our legal disclaimer at burnyourboatswealth.com. Thank you and have a great day.